Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. So today we'll look at the Bitcoin price chart, we'll dip into the equities, we'll check on the yield curve, and I'll also show you a bit of the spending I've noticed on chain. It seems there are a few FOMO buyers on the breakout that are giving up already. So don't miss that later in the video. If you enjoy this content, make sure to give my video a thumbs up and please subscribe to the channel. All of your support helps me to continue doing what I love. Thank you so much. We have many things to discuss and time's a-wasting, so let's get to it. All right, friends, well, here's our price chart. So in order to see what's been going on, let's first re-add these resistance zones that we had been looking at together in the last couple of videos. So we have these couple of spots right here. First started by this area that price was finding a way to avoid closing in. During the entire consolidation, we had noted this was a relative no man's land for price. We've now gotten back through this zone, just blitzed right through it, which we explored in detail in the last video, so you can check that out with a link in the description down below. We got through this level here, and what we were looking for as the next leg up was something up in this region. But before we got there, I did express the likelihood that I thought we would backtest this level here, the lower end of the range, and that's almost exactly what we got to a pinpoint. Now it is still developing. There's still more time for it to come down, maybe even flash lower. That kind of micro structure is not really the focus of this channel. But on the daily time frame, this looks like a healthy rally with higher lows as we've talked about, and we're currently back testing what had previously been resistance, trying to turn it into support. So this is very constructive. I think we may develop here for another few days and then continue our zipper climb, hopefully slow, steady climb up to the top of this range, and then we'll see what happens from there. Now, one other thing I noticed, I'll call it an observation rather than a concern, but it's something worth pointing out, is that volume has been kind of structurally declining. This is on Coinbase since around this part right here, since basically the beginning of March, the most recent rejection of this resistance area before we finally broke out of it. This was a point where we last saw a big spike in volume, and it's been declining basically since then. This isn't the volume profile I'd like to see. Ideally, we would be seeing increasing volume as price is increasing, but instead we've got a bit of a descending wedge here. Not the greatest volume profile. And in fact, if we go over and we look at it on Binance, it looks really similar. It looks pretty much the same here. Declines, descending wedge of volume since this same general part of the market here, since the beginning of March. So this isn't the kind of profile we want to see. And it's something to keep in mind as we continue to go through here. You would want volume, particularly on these green days, you'd want volume to be rising. Now on the equities side, we talked about in the last video, each of them battling the major indices with their 200-day moving averages. And it seems that the majority of them are finding that a struggle to get through. The S&P had broken out well above it, and it's now coming down for a backtest. The Dow Jones is in the middle of its battle right now, and we can see the NASDAQ has been rejected by its 200-day. Still some work to do here for equities, and this is okay. You know, they had a very strong multi-week rally here off the lows through most of the month of March, and price doesn't move in a straight line. So I think it's reasonable that we're now seeing a little bit of slowdown here on equities. But, you know, we just ended the month of March, which ended the first quarter as well. And for the S&P 500, the first quarter of 2022 was the worst quarter since April of 2020. Almost 5% negative returns on the S&P year to date through January to the end of March on the S&P. Not the start to the year that people were looking for. And a little ho-hum when you consider how strong the rally was through the month of March. People thought it might save us, might pull us out of the depths. Nope, we still logged an almost 5% deficit for the quarter. So investors are looking for softer ground here in Q2. Earnings may be slowing down after a year of insane growth. I'd be surprised if we saw continual big earnings beats in the next couple of weeks, but we'll have to see how that plays out and how the market reacts to that. In the last video, the yield curve is something we talked quite a bit about, particularly the spread between the 10-year and the 2-year Treasury yields. And what we have finally gotten is an inversion of this spread. It is broken below zero, and we're finally seeing a print on my indicator here. Now, I announced on YouTube and on Twitter, this indicator is shared publicly now for anyone who has TradingView to use it. It shows the spread between the US 10-year and 2-year Treasury, and it highlights when there is an inversion, which means that the value is below zero. This indicator, like I said, is free to all. I'll leave a link to it down below in case you missed my announcement. You're welcome to use it if it helps you. And now that we've seen this yield curve inversion, particularly of the 10 and the 2, this usually signals, at least in my lifetime, that a recession is coming for the markets in the next year to 2 years. Now, oftentimes, the reaction of the recession to the yield curve inverting is separated by a considerable span of time. It can be many months, it could be over a year from now. And in that time, the market could do its own thing. It could continue to rise. And that could happen in the face of many very obvious market headwinds as investors scramble to accumulate yield before the impending downturn. There's been a lot of liquidity sidelined in the last couple of months as we've been witnessing markets deleveraging, and many of those bags are looking for gains at this point. So there could be some insanity over the next couple of months while the market tries to squeeze as much juice as it can out of what appears to be a deflating balloon. And since we know that the yield curve just inverted, what does that mean for the market, right? We explored this a bit in the previous video, but there's a point that I didn't make there that I think is relevant to add to the conversation, and it relates to the federal funds rate. So what we've got on the screen in black is the S&P 500 for market reference. In the green line, we have the effective federal funds rate. This is the value that changes when the Federal Reserve raises and lowers interest rates. This is the core interest rate. And you can see we've pretty much been at zero now for the last couple of years. In red, we're showing US recessions. They're highlighted for you. And down at the bottom, we've got the 10-year, 2-year Treasury yield spread. And these blue periods indicate inversion, right? Which is what we've been talking about. And if we zoom in over here on current times, we can see we just got our inversion print. And so just eyeballing the chart, we'll identify some places where we can see the interest rates began rising. And then I want to compare them to where the yield curve was at that time and what the market was doing. So if we look back here in the 80s, back about as far as my indicator can go, there's a period here where interest rates were rising as the market was rising. This is following the 1987 flash crash. We got rising interest rates, rising market, and then we get an inversion of the yield curve. Interest rates began falling, and then at some point we get a recession shortly after the inversion. This is the pattern that the market is used to seeing. We're used to seeing rising rates, market rises, yield curve inverts, Fed breaks something, rates start coming down, recession. That's the pattern. Looking over here in the 90s, this is one of those instances that's a little different from the others in this chart. Here's a period where rates began rising in 1999 after the first of a pair of inversions of the yield curve. So we got an inversion. The Fed begins rising rates. The market still continues to climb. But what does it end with? Literally the dot-com bubble, a massive recession and market crash. So the Fed rose rates into a recession and the market rolled over on itself. This example here is the closest thing on this chart to the Federal Reserve raising interest rates near a yield curve inversion, which they are doing right now. This federal funds rate is only showing to about February. Where it is actually right now is up here. It's like at about 25 basis points, right in this area right here. And we just got an inversion of the yield curve. And the federal funds rate is set to continue rising over the next few months. And it's doing that while, as we just pointed out, the 2-year yield is surpassing the 10-year yield. Short-term rates have exceeded longer-term rates. But when we look at 2004, a huge hiking schedule began. While the market was still climbing, ultimately we got inversion and then recession, right? This again is the same pattern that matches matched back here in the 80s, and then here in the 2000s, and then again last decade. The rising of interest rates, the rising of the market. Ultimately, we get a yield curve inversion, rates begin falling, and we get a recession. This pattern, and this pattern are identical. These are the same three things happening in the 80s, in the middle 2000s during the great financial crisis, and then just a few years ago when we got the COVID recession. But right now, the market looks a little bit like 99, 2000. The major difference being the effective federal funds rate is starting from zero, and federal debt levels are much higher now than they were in the middle 2000s. We're entering an uncommon period for the market. The bond market is screaming at the Federal Reserve that they are vastly behind the curve and they don't know what they're doing. Meanwhile, Jerome Powell is talking about raising the cost of capital in an effort to fight inflation while the market is already flashing red signs, red flags. This has got me concerned as it's hard to understand how all these pieces play together, but it certainly makes it very reasonable to be apprehensive about any of this price action leading to a new bull market. Based on history, we are heading towards a recession in the next year or two. It is obvious when you look at the last few paradigms that we talked about. Rates can rise while the market rises. That is possible. Will it set new all-time highs in that environment? I cannot say for certain, but we may still see upside despite the fact that the market is screaming at us that it is unhealthy, inefficient, and needs a pullback. So just want to keep in mind all of these factors when we talk about Bitcoin, when we talk about price action, when we talk about price targets, and what we think the market's going to look like in 6 months or a year from now. It's very difficult to project those things, in part because the people that are managing the money seem to be vastly behind the curve on addressing the real problems. So moving on from the economics a bit and reaching back into the Bitcoin space, we still have a consistent and steady discount regime in the perpetual futures basis, which means that speculators in perpetual futures are still holding those instruments behind the spot market. There's still some bearishness going on there, and we're waiting for a softening of this pattern before we can start to feel like the futures market is coming around to this rally. But what we've seen throughout this action so far is that their bias, their agenda hasn't changed whatsoever, at least from the perspective of the basis itself, the difference between the prices of the instruments. And as we noted with the perpetual basis, we are also still seeing a very flat funding rate. Now it does oscillate a bit, it chops around a little, and in fact, I'll even put a moving average on here to smooth this puppy out a little bit. Where it's been for the last few months is at essentially baseline. So the Binance perpetual future, the tether-based future, is currently the largest one of the perpetual instruments for Bitcoin. And the way that their funding rate is calculated is that it defaults to this 0.01% value when there isn't any clear aggression in either direction. Now, funding has been unable to get above this value for any period of time at all for the last few months, since before the liquidation event in early December. And so by seeing the funding rate continually chopping around below what is considered a baseline clamp value, and knowing that the Binance future is a huge part of the market, this shows to me that there are still shorts present here. If I throw my drawing tool on here, let me make sure you can see the color of my drawing. Getting these little like flashes down here into the negative, these happen either because the spot market is leaving futures behind, which isn't really occurring here because we're not seeing strong rallies, or it's because of bearishness in futures, because of people hedging and selling their positions. It's hard to say for sure. I think there's a fair amount of that going on. But knowing that we're still underneath this clamp value here, it's pretty obvious there are a lot of bears in futures. They still are there, but they're showing more of a hedging behavior and less of a giga short behavior. Rather than purposefully trying to drive price into the ground, they appear to be more hedging themselves to the downside, more of a sophisticated positioning. At least that's my interpretation of it. And what I'm waiting to see, what I think may begin to show a change in this dynamic, and possibly also a change in the dynamic of the futures basis over here, here is if price ultimately gets back to 50K. 50K is about right here. I think that if price makes its way back above this level and shows that it's trying to make support out of 50K, I expect that we will see a changing of this here, because where we are now is still very much in the median of price action for the last year. And the risks here are still more in the camp of the downside, I would say. Just knowing how many traders and perps go gig along when we hit all-time highs, I have a strong suspicion that once we get sustained price action over 50K, we'll start seeing more aggression out of these traders down here. And we may see a softening of this dynamic that we've been observing. So that's what I'm watching for out of futures. And other than that, I haven't been seeing a lot of signal out of what we get from the funding rate and the changes to open interest outside of micro time frames. So I haven't been looking at it that closely recently. Now, one of the last things that we'll talk about today relates to coin spending on chain. And where we'll start by looking is over here on my adjusted spent output profit ratio chart. It's got a 24-hour moving average on it. What I've noticed here looking at this chart, the spent output profit ratio printed what is its lowest value since July, since all the way back here. We suddenly got a huge spike down in the spent profit ratio on a 24-hour basis. So let's unpack that a little bit. What does that mean? So we've seen here a dramatic dip in the profitability of spent outputs. But if I look at net profit and loss, it's still largely positive, though it does seem to have declined a bit from where it was a couple of days ago, right? It was up here and it has declined some back down to baseline. This does seem to be partially an effect of this non-profitable coin spending here. But where do we think this is coming from? Here's our spent volume age bands chart. And what I've done here is filtered it down to where it's only showing the volume of coins moving that are 1 hour to 1 week old. By discarding coins that are less than an hour old, we get rid of relay transactions and a lot of noise in the ledger. But for everything else that's less than a week old, it's represented here on this chart. And what do you know? Pull my drawing tool up here, get it to where I can draw on this beautiful bad boy. And what do you know? We've got increases here, friends. Younger coins from an hour to 1 week old, their spending is increasing, right? And we're currently, in the last couple of weeks, we've been printing some of the highest values this metric has seen in the last couple of years, with the exception of July 2021. So what does this mean? It means that we have a lot of coins moving on chain, a lot of spending on chain that are coming from newer coins. And when we back out and we see this increasing volume, right? We see rising younger coins moving while also seeing this significant dip in profitability of spending. It says to me that we have a lot of young coins moving and a lot of them are at a loss. I think we have a considerable amount of people that FOMO'd in up here as we broke over this resistance level, this 45, 46K resistance level, and these people are immediately dumping their coins in weakness. And that's why I think we're seeing a spike in spending of coins that haven't even made it to 1 week old yet, because they literally bought this breakout and they're giving up on the backside. So I see a little bit of weakness. I see some paper hands here. Some of the losses that we're seeing, a few of these losses could be from people earlier last year. They could have coins in loss from this top, or maybe even from April or May, spending in smaller amounts. But by and large, it appears to be very young coins. As we can see here, it's more than 50% of the volume every day, coins that are between an hour and 1 week old, a significant portion of transaction volume. Yet their profitability had a dramatic dip here on the flush out down to 44K. So that's a dynamic I thought worth calling out. I think we saw a fair amount of FOMO over 46. And this dynamic here is something that would be negative to see unfolding with frequency if price continues to rally. So if price finds itself over 50K, over 51, over 52, maybe it starts to get over this September 7th high right here. If any of those things come to pass and we start seeing more negative profitability, people dumping out from loss that are held just above price, those people could provide headwinds, and it will be important to see market strength counteracting those forces. So let's bring all this together. We talked about younger coin volume on chain. That's what we were just discussing. It seems a fair amount of coins were acquired on the breakout recently and are being spent once again in loss on the backside of this very brief breakout. We are still seeing chop in the perpetual futures market. The funding rate is not showing a lot of signal and it's still below a baseline value in conjunction with a steady, unwavering discount basis, meaning that these instruments are being depressed below the spot price, which suggests to me consistent hedging and net shorting behavior out of futures. There certainly is not a lot of aggressive longing going on there to overpower it. We know the yield curve inverted, and as we have explored in depth here together, inversions of the yield curve are a bad sign for markets over the next year to 2 years, but there could be upside in the short term before investors largely come to grips with this new paradigm. And this inversion here and the knock-on effects of it are part of what's informing my general apprehension about calling for all-time highs for Bitcoin and risk assets generally. And on the Bitcoin side, we got our backtest, at least so far, of what had previously been resistance, trying to turn it into support. It is still developing. Maybe we get another couple of flashes here, but I expect we will ultimately get back over this level and make our way up to 52K. Because after we get over this level, we really enter the interesting part of the market, in my estimation. And that is when we look to face these retrace levels. I've made it known on my channel that I do think Bitcoin will have a tough time getting through this level right here between 55 and 58,000. And my current base case, based on everything we've talked about throughout the history of my channel, Bitcoin's own market cycle, with what we're seeing in equities, with the amount of debt levels we're currently facing, record commodity and energy prices, and now seeing an inversion of the bond yield curve, my base case that Bitcoin will run out of steam somewhere in this area is currently heavily supported by geopolitical and macroeconomic factors. I could still be wrong. I may eat one on the chin and be completely off base, but I do suspect Bitcoin is not on the way to new all-time highs in this current move. And if I end up being proven wrong, I will be one of the happiest people about that because I am long Bitcoin and I do want the number to go up. But I also have to be honest about what I see, and there are plenty of reasons to be cautious about the next few months of price action. So that's where we'll leave it today. I want to keep this video on the lighter side and just show you that some of our expectations for this week played out pretty accurately. I'll aim to make another video on Monday, and then after that, I'm traveling to Miami for Bitcoin conference from Tuesday through Saturday. I am taking my laptop and microphone to try to produce a video while I'm there. I don't know if it will be a produced, packaged video like this one, or if I'll end up doing a more casual live stream. That might be the way to go. But I'd like to show you guys the inside of the conference if they let me film there, and it's important to me that we stay in touch throughout the week and that I don't leave you guys hanging. So we'll figure something out. I hope you enjoy this content and that you find value in the way that we analyze the markets together. If you do or you don't, if you have any comments about the things we talk about or questions for me, please, I welcome you to leave the feedback in the comments below. I read and respond to as many of them as I can. And that's where we'll end things today. I hope you find time for yourselves on this beautiful Saturday. I'm going to get outside as soon as I publish this video. And we will talk again in a few days, friends. So until then, take care of yourselves, be kind to each other, and we will chat very soon. Cheers.